It's finally time to sell your house. You have real estate agents lining up at the front door, bringing you comps to tell you the value of the property. You're calling all of those signs that say, "We will pay cash for your house." You contemplate doing it yourself and putting it on Zillow. You can reach millions of people out there. Besides, real estate agents make how much for what? And finally, 5 years ago, when the house was remodeled, you put white paint on the fence and your favorite tile in the master bathroom. Your house is worth gold. Does this sound familiar? With so many options out there, so many opinions, and so much information, where do you even start? It's easy. Ask yourself the following question. What are the most important things to you when selling your house? For example, are you going to try and get the most money out of your house and squeeze every last penny out of it? Or are you running short on time and need to sell it tomorrow and willing to take whatever you can get? How much work are you willing to do to the house to fix it up? Or do you want to do nothing at all? Is there anything else that you can think of that's important to you before answering the most important question? Which is, what are you going to do with the money once you sell the house? Some examples are you going to buy a larger house? Perhaps put the money in the bank and collect interest. Maybe buy a brand new sports car or travel the world. Maybe you're just cashing in an inheritance. You just need to answer the question, what are you going to do with the money when the house sells? Why is this important? It's simple. Finding additional buyers based on the answers to this question will bring in more offers and higher offers. Let's take just a moment to dig into the numbers a little bit. In 2018, according to the Northern Nevada Regional MLS, of the transactions that closed that were cashed, the sellers received 96% of their original asking price. If they were conventional loans, they received 97.62% of the asking price. If they were FHA loans, the seller received 98.1%, and if they were VA loans, it was 98.5% of the seller's original asking price. Now, let's assume we have a house on the market for $300,000. It makes sense that a cash buyer would need $300,000 in the bank to make a full price offer. A conventional buyer would need $60,000 in the bank, assuming 20% down. An FHA buyer requires only 3.5% down payment, that's $10,500. And finally, a VA buyer requires $0 for a down payment towards a new house. As you can see, there is a direct correlation between how much upfront cash is required and the amount a buyer is willing to pay you for your house. Now, why is this? Well, it's actually quite commonsensical. How many people in the world have $300,000 in the bank? Not that many. They're going to want the largest discount. How about people who have $60,000 in the bank? Well, there's more of them than there are $300,000 people, but they're still going to want a discount. Finally, folks who have $10,500 in the bank, they're going to get a little bit closer to asking price. And finally, people with $0 in the bank, that's everybody. No one's going to be concerned about the price they pay. The only thing they're going to be concerned about is their monthly payments. Now, getting back to why we're here, what is it we're really doing? Well, what we're doing is we're taking a bucket and filling it up with as many buyers as possible to get you as close to your asking price. Sure, we'll start with the most basic buyers that have cash, then the other three types of popular buyers that lending institutions must agree are worthy of owning a home. We're talking buyers with conventional loans, FHA loans, and of course, VA loans. And this is what most buckets are filled with. But why leave out the 40 other types of buyers? What about someone who moves to town with $200,000 in their savings? They want to buy your house, but the bank says, sorry, you need another year at your job. Or there's a self-employed person who owns millions of dollars in real estate and assets. They keep a little cash in the banks, but the banks won't touch them because they do their own taxes. Would you be willing to take part cash plus whatever it is you're going to spend your money on? Say $260,000 cash plus a Ferrari for your house? Finally, I know someone that will pay at least $50,000 more than your best cash offer. Remember, what we're trying to do is fill up your bucket with as many buyers as possible to get close to your asking price, if not more. Okay, let's go ahead and get started. Lesson number 1, sell your home for cash. So this is a very common way of selling your house. Today we're going to look at what does this type of sale look like. Fairly straightforward. What are the pros and cons of a cash sale, and who ends up with what at the end of this cash sale. So as everybody knows, every sale has a seller, let's call that you, and every sale has a buyer, let's call them they. Well, not everybody knows that every sale is nothing more than an exchange. You, the seller, are trying to sell your house or exchange it to a buyer, and a buyer is trying to exchange their cash to you for the house. So at the end of the sale, you end up with cash and they end up with a house. This makes sense, right? Now we're going to hammer home why every sale is nothing more than an exchange. Let's change the labels. Let's say that you are actually a buyer and they are a seller. You're simply trying to buy a pile of cash with your house, and they are trying to sell you a pile of cash for your house. In other words, this is all just an exchange. And a real quick summary, you are exchanging a house for cash. They are exchanging cash for a house. The net result is exactly the same. Today's sale, sell your house for cash. Cash is king, as the saying goes. Why? Because you can buy or invest in anything as soon as you have it. So today's lesson, very simply, you want to sell your house to a buyer, and they are going to give you a pile of cash. Since this is a fairly straightforward concept, let's just jump right into the advantages and disadvantages of selling to a cash buyer. Well, number 1 is there's no appraisal required from the bank, so you don't need a third party's opinion of value. There's no need to wait 30 to 45 days for the bank's paperwork. You can close as quickly as you want. The house can be in any condition, and when you have the cash, you can spend it as quickly as you like. Some of the disadvantages are that cash buyers expect a deep discount, maybe $30,000 on a $300,000 house. 2, the cash buyers are more willing to walk away from a sale if they don't like it. They won't have any money into an appraisal. And finally, if this was your investment house, there could be a very large tax bill for you. So you can see there are definitely advantages and disadvantages. Just remember, the buyers are giving you those advantages, which is why they want such a steep discount. On a side note, if you must have a cash offer, get in touch with me via phone or email, and I will get you an offer within 24 hours. So, who has what when the sale is complete when you sell to a buyer for cash? Pretty straightforward. You have a pile of cash as the seller, and the buyer owns the home. Now, on to part 2. Sell your house to a buyer with a conventional loan. The goal for you is to get as much cash as possible for your house. However, the biggest difference is the buyer doesn't have all of the cash. They will use some of their own savings, then they'll go to a bank and borrow some money to hopefully get as much cash as possible to give you for the house. Using our $300,000 example, traditionally, conventional loans require the buyer to come up with 20% down, or $60,000, and hope that the bank will loan them $240,000. If the bank decides to give the buyer the $240,000, they're going to require that buyer to sign an IOU, also known as a bank note. Additionally, and here's what most people don't understand, the bank will also make the buyer sign a deed of trust, also known as a trust deed, which basically says if the buyer does not make payments as agreed to in the IOU or bank note, the bank has the right to sell the house at a public auction to recover the money that is owed to them. You may have also heard this process called a foreclosure. Why is this important to you as a seller? Because it affects the sales process. Remember, banks are in the business of loaning money. They don't want to foreclose, but they do need to protect themselves and try to get as much insurance as possible to make sure they get the money back they lent out. In addition to making sure the buyer has skin in the game with a down payment, they will also need to verify the buyer's income history to make sure they can pay back the loan and also look up their credit history. This research or underwriting adds time to the sales process. Finally, the bank will require a third party's opinion of value on the house. Most people don't understand that the only reason appraisers are needed in a sale is because the banks or lenders require them. Let's look at the advantages and disadvantages to selling to a buyer with a conventional loan. Since this buyer does not come out of pocket for the entire amount, they will usually pay more than a cash buyer. 2, the property can usually be in any condition. 3, the lenders have fewer restrictions to giving credits buyers for repairs. If the appraisal does not come in at contract price, conventional buyers may have some extra money to make up the difference. And 5, when the transaction is finished, you'll have a pile of money you can spend as fast as you want. Disadvantages. Third-party appraisal is required from the bank, and if it does not come in at contract price, the buyer can walk from the deal, or you may need to lower the price. 2, it will usually take 30 to 45 days to close the sale, and conventional loan buyers will want a discount, though not as steep as a cash buyer. And finally, if this is your investment property, there could be a large tax bill. So, who has what at the end of the sale? You have a pile of cash provided by the buyer's savings and bank. The buyer has the house, and the bank has an IOU and a deed of trust secured against the buyer's new house. Part 3, sell to an FHA loan buyer. If you recall our graph from earlier where we talked about how much someone is willing to pay for a house compared to how much they come out of pocket up front. Now let's erase money out of pocket required and write in what the average sales price is based on our data. You can see that on our $300,000 example, cash buyers' average sale price would be $288,000, while conventional buyers is $292,860. FHA buyers is $294,300, and a VA buyer topping out at $295,500. By the end of this part 3, you will start to understand why some types of buyers require less money out of pocket, which means higher offers and better sales prices for you. So, what is an FHA loan? Well, the Federal Housing Authority, or FHA, was created by the U.S. government in 1934 in response to all the foreclosures resulting from the stock market crash of 1929. One of the goals of the FHA was, and still is, to help Americans buy homes to live in. You could probably say this was the beginning of the saying, the American dream is to own a home. Well, one of the ways they made home ownership affordable was by creating a government-sponsored mortgage insurance policy that allows buyers to only need 3.5% down as opposed to the traditional 20%. The mortgage insurance premium is paid up front and over time by the buyer. So just like before, you're trying to get as much cash as you can for your house. And the difference here is the buyer is going to use their own money plus money from the bank, as well as have to buy a mortgage insurance policy from the government. Let's take a moment and see what it costs for an FHA buyer to buy your home for $300,000. Well, they would need $10,500 from their bank account plus $289,500 from the bank, and the mortgage insurance policy fluctuates over time. Currently, it's 1.75% or about $5,066 for a grand total of not $300,000, but $305,066. Why would somebody pay more than $300,000 for this house? Well, it has to do with the upfront out-of-pocket expenses. The buyer needs $10,500 from their savings plus $5,000 from their mortgage insurance policy for a total of $15,566, which way more people can afford than coming up with the 20% down or $60,000. As a quick reminder, going back to the conventional loan segment, in order for a bank to loan you the money, they're going to require an IOU plus a deed of trust, which says they can sell the house if you don't make the payments back. In our conventional loan example, the buyer borrowed $240,000. If the bank actually had to auction the property off and got the $300,000, they have about $60,000 of wiggle room to pay for attorney's fees and also any damage that may have been done to the property and resale costs as well. That's also known as equity. Obviously, with an FHA loan being $289,500, there is much less equity or wiggle room. Furthermore, let's say the house was damaged and the bank could only get $280,000 at auction. That means they lost $9,500. This is where the mortgage insurance comes in, backed by the government, that will reimburse the bank for any losses up to a certain amount. Why is this important to you as the seller? Well, in addition to what a bank would normally require for a conventional loan to ensure they are paid back, which includes minimum down payment, researching income and credit history, and obtaining an appraisal of the house, FHA is going to have their own requirements before allowing the buyer to secure the FHA loan mortgage insurance to complete the sale. By the way, the term FHA loan and an FHA mortgage insured backed loan will mean the same thing from here on out. So remember, when there is a conventional loan, the banks are only concerned with the current value of the house when the sale closes, no matter the condition of the house. However, since FHA is in the business of helping people buy homes to live in, also known as owner-occupants, they will require the buyer to live in the house for at least 1 year. Additionally, they will require not only the buyers to qualify for the loan, but also the house must qualify. Some of the requirements are earthquake straps on water heaters. The house must have a working heating source and an operable cooking source like a working oven or stove. The roof must be in good condition, and there cannot be any peeling paint around the house. And there are additional conditions that change over time. The person who determines the condition of the house is an FHA Certified Appraiser. So in addition to determining the value of the house for the bank, the appraiser will identify any items that must be fixed in order for the house to qualify for the FHA loan, which must happen in order for the buyers to only need 3.5% down. In other words, be prepared to do some repairs on the home before completing the sale. This adds additional not only time, but also expense to your side of the sales process. I cannot emphasize enough, during the FHA sales process, I strongly recommend waiting to negotiate any repairs or credits until the FHA appraisal is complete. By this time in the sales process, the buyer should have completed the general home inspections and made the decision to move forward with an expensive appraisal. Remember, appraisers are human beings, and with guidelines changing over time, one appraiser's checklist can vary to the next. Wait to see what your FHA appraiser determines needs to be fixed in order for the house to qualify for the FHA loan before negotiating any further repairs. Two quick side notes: FHA does have a maximum loan limits based on what county your house is located, and most people don't know that every FHA loan is assumable. If you have a loan that has a lower interest rate than the market value, you should shout that out to the world, because they may pay a higher price to get a lower interest rate on their loan. Okay, let's look at the advantages and disadvantages to selling to an FHA loan buyer. 1, they will almost always pay more than a cash or conventional loan buyer. FHA buyers are more emotionally attached to the house since they'll be living in it, and less likely to walk from the sale when the inspections and negotiations are happening. If you currently have an FHA loan on your house, you may be able to command a higher price if your assumable rate is lower than the current market rates. When the sale is complete, you'll have a pile of money to spend as quickly as you like. Disadvantages: third-party appraisal will be required from the bank. If it does not come in at contract price, buyer can walk from the deal, or you may need to lower the price. 2, the house must also qualify and meet certain conditions before the sale can close. There are more restrictions to what kinds of credits you can give to the buyer, and it will usually take closer to 35 to 45 days to complete the sale after you accept an offer. And finally, if this is your investment property, there could be a large tax bill after the sale. Okay, so who has what at the end of the sale? You, the seller, have a pile of cash provided by the buyer's savings as well as the bank loan. The buyer has the keys to the house, and the bank has an IOU and a deed of trust secured by the house. In addition, a mortgage insurance policy basically backed by the government. And finally, part 4, sell or exchange your house to a VA buyer. What is a VA loan? A VA loan is also called a Veterans Administration loan because back in 1944, the Veterans Administration, which we will call the VA from here on out, wanted to help veterans as well as active members of the American military get into homes after World War II. And just like the FHA, they did and do this by providing their own types of mortgage insurance. Since this is a government-insured program, there are a lot of similarities to the FHA loan. So we'll quickly compare the two and wrap up parts 1 through 4 of how to sell your house. Just like selling to an FHA buyer, your goal is to get as much money as possible for the sale of your house. However, Unlike an FHA buyer, the VA has programs which are much sweeter and allow the VA buyer to buy a home with no money down, therefore using 100% of the bank's money to purchase your house. Just like the FHA buyer, the VA buyer will need to purchase an insurance policy. However, if you recall, the FHA buyer pays their insurance policy upfront and over time. The VA policy only requires an upfront cost. This actually allows the VA buyer to qualify for more for their loan because overall their monthly payments are less. So, how much does it cost up front for a VA buyer to buy your $300,000 house? Well, they need no money down as a down payment, and the current cost for the insurance policy is 3.3% of the loan amount. So, for the $300,000 house, the buyer would need $9,990 to purchase the VA insurance policy, which is still more favorable than the $15,000 the FHA buyer needs. However, the VA says not only will they guarantee 100% of the loan to the bank, they will actually guarantee up to 103.3% of the house's value without needing to pay any additional mortgage insurance. So, in summation, the VA buyer does not need the $9,999 since they can actually put that cost into the loan and pay it out over time. And the pieces of a VA buyer are just like an FHA buyer, where the VA buyer will go to the bank. They will need to give the bank an IOU and a deed of trust, which says that the bank can foreclose on the home if the note is not paid back as agreed to. And just like the FHA, the VA will have policies in place to minimize the risk of insuring loans that many times exceed the value of the house. It will include income verification, checking credit scores, making sure the home appraises in value, as well as the condition of the house qualifies. Though similar to FHA's requirements, there are some differences. For example, VA may be less worried about peeling paint. However, they will require a clear pest inspection that you, the seller, must pay for. So, just like the FHA loan, wait to negotiate any repairs until not only the appraisal is complete, but also the pest inspection. If there are any required repairs needed based on the pest inspection and/or the appraisal, it must be done before the loan will be approved for the VA buyer to pay top dollar for your house, since they are coming out of pocket with little to no money. Another side note is that VA loans, just like FHA loans, have limits based on what county the home is in. This side note is important for you to know as a seller because it may help decide how you want to market your house. Let's say you want to ask $325,000 for the house, but know you will accept $310,000, and you are in a hurry to sell it for whatever reason. You do the extra research and realize VA limits for your county are $312,000. Should you list the house for $325,000 or open it up right away to all the VA buyers who pay top dollar and just market your house at $312,000? Okay, let's get to the advantages and disadvantages to selling to a VA buyer. Advantages: because the VA buyer is coming out of pocket with no money, they will usually pay top dollar. Buyers are usually more emotionally attached to a deal and will be less likely to walk from it since they're going to live in the house. And when the transaction is finished, you have a pile of money you can spend as you like. Some of the disadvantages are third-party appraisal will be required from the bank. If the appraisal does not come in at contract price, the buyer can walk, or you may need to lower the price. Third-party appraisal also has conditions for the property that must be met and must be repaired for the property to qualify. And you must also pay for a pest inspection and any repairs to make sure the house gets a, quote, clean bill of health. It usually takes 35 to maybe 60 days to close the deal. There are more limitations to offering credits for repairs to the house. And if this is an investment property for you, there could be a large tax bill. Okay, who has what at the end of the sale? You have a pile of cash, most likely provided 100% by the bank. The buyer has the keys to the house, and the bank has an IOU, a deed of trust secured by the house, as well as a mortgage insurance policy guaranteed by the Veterans Administration. And that wraps up parts 1 through 4 on over 40 ways to sell your house. Should you have any questions about what you've seen in this video or any of the items listed here below, please feel free to contact me directly. Stay tuned for future videos and have a wonderful day.